What's up, everyone? It's Scotty with MoneyVest. So markets here selling off quite aggressively. We had the NASDAQ here dropping a little bit over 1.5% on the day. I'm also going to cover the prices of gold because gold has been on a very significant rally over the last few days. But nonetheless, NASDAQ here down 1.5. We've got the Dow Jones dropping over 200 points and the S&P 500 also selling off quite aggressively down over 1%. Pretty much breaking down below its 200 simple moving average and also coming down to 4,200, low 4,200s. And it's now going to be very, very interesting going into next week as big tech earnings start once again rolling in. So it's really going to come down to companies like Apple, like Amazon, like Meta, like Google to basically lift the market, or this acceleration could continue. The selling pressure could continue and accelerate even further. So hope you guys are doing great. As always, make sure that you drop a like. Don't forget to subscribe to the channel. That's all I'm asking in return. And link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything is going to be included, as well as the 16% annual discount that's available till the end of this month. So just a few more days left for you to take advantage of that discount as well. So this right here, state of the market, the 10-year crosses over 5% for the first time since 2007, something that we discussed in our previous videos and our live streams and market updates as well. And if you come over to the 10-year yield, we are right now sitting at just over 4.9%, but the high was a little bit over 5%. So just quite a crazy number, but we did indeed get up to over 5% here for the first time in over 16 years. So the stock market is watching the bond market and doesn't like what it sees. This was David Donabidian. Sorry for the mispronunciation there for the last name, but he's at CIBC Private Wealth Management. Yields are rising even with the relatively good news about inflation. This is the primary reason the stock market has been weak. And I did a short on this, 3 reasons kind of affecting the market right now, hurting the stock market right now, and hurting the market's ability to rally. Number 1, yields. Number 2, dollar. Number 3, oil prices. Those are the trifecta of trouble, basically, if you want to call it, is what's hurting the market and its ability to basically see more upside. And it's all about risk and reward. It's all about just kind of having an understanding of equity risk premiums, which are hitting their lowest levels in over 20 years. As yields continue to move higher, our discount rates are also going to move higher as we are doing a lot of these stock analysis for these companies. So Tesla stock ends the week down 15%, the worst performance of the year, and this is all on the back of earnings. We broke down the earnings in one of our previous videos. It's still up on the year, so it's still having a pretty phenomenal year, but down 15%, pretty big red candle coming down to low 200s. I did a short on a Tesla's technical analysis as well, so make sure that you do check out those videos. So this was the state of the market. It's quite interesting, quite amazing, and it's going to get very, very exciting as well as volatility continues to go up. And look, I want to be very clear. I want to make something very clear. Markets coming down is never a bad thing, right? A lot of people, I know everyone starts to get very angsty. Everyone starts to get very anxious and nervous when markets are coming down, and we're seeing our portfolio values come down, stocks are selling off. It's never a bad thing, right? If you walk into a store, right, and you are looking at all these different products, do you want their prices to be higher or lower, right? Of course you want them to be as low as possible. You want to see discounts, you want to see deals, right? You want to see prices coming down so you can actually take advantage and buy, right? And in this case, it's even better. Why? Because we're buying assets. We're not buying liabilities, right? Most people get excited when prices go down for liabilities. A car is 20% off, great. A phone's 30% off, fantastic. Let's buy more. People get excited when liability prices come down. These are asset prices coming down, right? So it should be even more exciting for everyone. But instead, again, that's how human psychology works. That's how market psychology works, where market selling off, you don't see a line queuing up to buy stocks, but instead you people running away from those buying opportunities. And that's exactly what our whole sort of premise is. When volatility is high, it's time to buy. And VIX is not there yet. We're watching very, very closely at 30 levels. And another thing that I want to mention is that it's not a buying opportunity every day, right? That's very, very important to understand, because the volatility, if you're kind of basing your decisions off of dollar cost averaging frequently, disregard everything that I just said, right? You're on a path to DCing every single week. That's what I'm doing with VUG and SMH. Regardless of market, regardless of macroeconomics, regardless of what's going on, that's a dollar cost averaging strategy, frequently buying a certain amount of shares, not really shares, but certain amount of dollar amount that you're putting into the market, and you're dollar cost averaging consistently over weeks and months and years. And that's what I'm doing with VUG and SMH. But if you're looking at individual stocks, but if you're looking at trading opportunities, if you're looking at serious dollar cost averaging opportunities for individual stocks or even for index ETFs, they don't come by very, very often, right? If you're lucky, the volatility in the market gives us one, maybe two serious dollar cost averaging opportunities in a year. Again, in a year. It's not a week, it's not a quarter, it's not a month. You go back, we've back tested this for the last 6 years. I've looked at the volatility for the last 34 years, and it is very clear to me that volatility will give you an opportunity, but it's not going to be that often, right? It's not going to be every week, every month. So yes, most of the times we're sitting on our hands. Most of the times we're patiently waiting for a deal. We're patiently waiting for prices to come down, right? And that's where patience comes in, right? Oftentimes, 90% of the times in a year, we don't have to do anything, right? We just have to wait for that sweet spot to get hit, and that's when we can start. And that's what happened 3 weeks ago. When volatility was high, we took a trade on TQQQ, on DFN, made some nice money, and then we were out, right? What did I say? What did we talk about a couple of weeks ago, right? We took a trade, we made some money, and then we got out. Why? Because this market momentum is very uncertain. We're not out of the woods yet. We're not in the clear. The moment the NASDAQ breaks above 15,000, the moment the S&P breaks above 4,500, that's when I will be a lot more confident. It'll open up our longs to take advantage of. But right now, we're not there yet. Right now, we're still in the context of a lower high and a lower low and in a downtrend. I think that's really important, but you have to tie a lot of these pieces together with the technicals, with macros, with fundamentals to better understand where we are in the overall market cycle, right? Is it time to be looking at opportunities or not? Right now, I think it's important to wait patiently for let the prices come to us, right? And that trading window to open up with volatility as being our key leading indicator. But this is the weekly chart. Tesla down over 15. We got Nvidia down almost 9. Oracle down 6%. Microsoft, Apple also selling off. Amazon down 3.5%. And Google and Meta also rolling over. So we did see a little bit of a rebound in some of these stocks. So I did a video last weekend going over 3 stocks, right? 3 companies for trade ideas. If you guys took advantage of it, congratulations, because Colgate was up. Take a look at this. This right here. CL, Colgate, in the last few days, so on the weekly chart, very, very nice weekly move, up almost 4%. Did a video on Coca-Cola, specifically, this week, up over 3%. And did a video on RTX, right, Raytheon. This week, it was slightly down about 1%. But the bottom line is that those stocks ended up outperforming. We had the NASDAQ. So if you did take advantage of those trade ideas, congratulations. Super happy for you. But going back over to the weekly chart, most of tech, most of comm services, most of financials, and basic materials and utilities are down. So all sectors, all 11 sectors are down here on the day over the last 1 week. Everything's down except for consumer defenses, and we did have 2 trade ideas on consumer defenses for this week. This right here, so we got oats, silver prices, volatility all pushing higher with corn, lumber prices, cotton, and lean hogs pulling back, with Bitcoin just a little bit under 30,000, Ether just under 1,600 as well. So going back over to volatility, trading over 21.7. Patience. Let it get up to 25 and 30. We're going to get up to some very, very high percentile levels. We're looking at over 90 percentiles for the VIX to get up to over 30. And that's when I start deploying some of the cash once again into the market. Crude oil here just consolidating sideways, so not really going anywhere. Bitcoin once again seeing some momentum back up to almost 30,000. And Ether also trading a little bit under 1,600 at the moment. And we do have, again, prices for yields. The 10-year sitting at just under 5%. And this is the uninversion that's happening. And, it's actually quite interesting. And I mentioned this in our Discord, that this uninversion is happening on the way up. This is quite an interesting bond market. Because in the past, every time we have moved up, so for example, 2019, when we have gone up, you've seen that happen on the back of 10-year yields coming down. So if I bring up this new price scale, what you will notice is over here. So let me just break this down very quickly. Okay. So what we're witnessing here is this. when the uninversion happens, and by uninversion I mean that the 10-year, the spread between the 10 and the 2-year is getting from negative to positive territory. That's how it's supposed to be in a normally functioning bond market. So when the yield curve uninverts here in 2019, 2020, right before the pandemic, then it starts to uninvert because we're starting to move higher. Look what happens to the 10-year. It starts dropping, right? It starts coming back down. And that's how it's supposed to be. If you go back to previous times when the uninversion happened over here, we're going higher. So this right here is the uninversion. You know what? Let me just remove everything so it becomes a lot clearer. This right here is the yield curve inverted, right? We're in the negative territory. But once we start moving higher, guess what happens to the orange line? That's the 10-year yield. It starts moving lower, right? It starts coming down exactly from that point. So you can see that we tap out right here in '07. And this right here is the entire sell-off in yields. That's the orange line. But that's exactly what I'm talking about. This is a very weird market, which is uninverting right here. It's going up on as the yields are going up, right? So you're seeing that uninversion on the way up. That's what I mean. There seems to be a lot of confusion, but that's what I mean when I say that uninversion's happening on the way up, is where the 10-year yield, the 20-year, they're all moving higher, and they're still uninverting because they're moving at a faster rate than compared to the short end of the curve, which has never happened in the past when the recessions have begun. So that's something to keep in mind. And this right here, I believe, is 2000s. And there we go. Same exact thing, right? Same exact thing. You see the inversion here, negative territory, and it starts moving higher. Look what happens to the 10-year yield. It starts coming down. That's the orange line you see on the chart, right? Over here, so again, 1990s, the uninversion happens like this. We start moving higher for the spread, and then look what happens to the yields. They start rolling over. So that is what we're talking about with respect to uninversion. Now going over to some of these charts. So S&P 500 obviously rolling over, coming down below its 200 simple moving average. 3 very strong red days for the market here. And if we do end up breaking down below 4,200, 4175 is going to be that next support level. And at that point, I think it's going to be very interesting. I wouldn't be surprised if we do end up breaking down below that level from this downtrend that continues to show signs of weakness for the S&P. And like I said, we're not out of the woods. This is the lower high and the lower low pattern for S&P 500. Talking about the NASDAQ, same exact thing. So this is the overall chart of lower highs and lower lows. And we are now starting to break down below 13,000. So that's a pretty decent breakdown, and next support's really going to be down to that 200 simple moving average, sitting roughly at around 12,700 for the NASDAQ. Talking about Apple here also getting rejected at this lower high. So we've been talking about these patterns and these charts for quite some time. So Apple here also getting rejected at 181, and right now starting to sell off. Support level is going to stay put at 172, and in case we see a breakdown below this, the next support is really going to be this lower low for Apple, down to 163 for this company. Talking about Amazon here also rolling over, down a little bit over 2.5%, down to 125. And that next support is going to be down to $121 per share. So this right here is going to be that next level of support. And of course, we are still very much in the context of this downtrend for Amazon. Talking about Tesla, and Tesla here definitely struggling quite aggressively. So we're still starting to break down further here. So we have completed this lower high and lower low pattern. And right now we're sitting in the low 200s for support for Tesla. That's exactly where the support is going to be. In case we see some more accelerated selling pressure, I wouldn't be surprised to see it in the 150s if it breaks down below this green rectangle, if it breaks down below this support level for Tesla. Talking a little bit about Meta platforms, and Meta here on the day also rolling over, down over 1.3%, so selling right back down, starting to break down below this support level. So this right here is the level that we talked about for Meta, and starting to roll right back down. And next support is going to be down to 293, 294 for Meta platforms. Talking about Nvidia here, Nvidia also rolling over. Low 400s are going to be that support level to watch. So this right here is going to be that very, very important level of support, and resistance is going to stay put inside this red rectangle for Nvidia, sitting roughly at around 480, 487. Of course, in case we see a breakdown below this, then this is going to be the gap that potentially needs to get filled for Nvidia. And we've been talking about this stock for quite some time. It's still pretty elevated. AMD is still hovering over $100, so it still continues to validate that support. at the moment. So right now, $100 is going to be that level of area of demand. In case we see a breakdown below this, well, then $80, low 80s is going to be that next support level to watch for AMD. Talking a little bit about PayPal, and PayPal here continues to sell off new 52-week lows, new 7 to 8 year lows, $53, and it continues to break down further. And that next support, unfortunately, is going to be down to $44. That's very, very far off, but you know, it's kind of, we'll have to wait and see where PayPal's next support ends up being, because I don't expect PayPal to come down to $44, but at the same time, it is the next technical support. But I do think that there's going to be some buyers stepping in, maybe in the low 50s or in the mid, or in low 50s or high 40s. There's possibility that, you know, buyers step in. But as you can see from a technical analysis perspective, I mean, if PayPal really comes down to fill this gap from 2017, that'd be crazy. That's like 6-year-old gap here for PayPal that it may come down to fill in. We'll find out. Square here, on the other hand, also dropping a little bit over 40 basis points, so coming right back down under $44. So lots of consolidation. Resistance is going to stay put at close to $51, $52 for Square. And this right here, obviously, is going to be that support level to watch. Talking about Netflix, and Netflix here also pushing down slightly, but very, very strong rally after the earnings, up over 16%, and it's got a massive gap now that it's left after the earnings. So this right here is going to be that potential gap that Netflix may or may not fill eventually, but next resistance is going to be all the way up to $449, $450 for this company. Talking about Google, and Google here also starting to roll over and sell off, down over 1.6%, so breaking down below these levels, and next support is going to be down to 126. So this right here is going to be that next level to watch for Google. And talking about Microsoft, Microsoft here also starting to sell off, down over 1.4%. Resistance is going to be sitting roughly at $340, and support level at close to $311 for Microsoft. So really, right now, we're just consolidating sideways for this company. Talking a little bit about Shopify, and Shopify here just consolidating sideways, down about 1.3%, so not really that much of a move. And finally, on Enphase. Now, I did a video on Enphase earlier, and I specifically mentioned that this sell-off is because of a couple of reasons. Number one, the macro environment, right? Higher interest rates are hurting Enphase and Tesla and a lot of these companies, because the cost of borrowing, right, is very, very high. So not a lot of people can finance a $20,000, $21,000 solar system, right, including the panels and the microinverters and everything. So that's number one. Number two, that's because of that macro environment, earnings and revenues are getting hurt right now in the short term, and institutions are mostly focused on the short term, right? They will sell this stock if the stock doesn't perform well over the next 6 to 12 months. But apparently, a lot of my things get lost in translation, and we had to go through this massive discussion on our Enphase video in the comments with multiple people who just completely misread like what I'm talking about. Like, this is exactly the reason, the macroeconomic factors with higher interest rates, and number two, institutions kind of position for the short term, hurting the stock right now, down over 20% at the moment. And does this change the long-term thesis for the company with renewable energy, with the energy transition towards green energy and solar panels and whatnot? No. I mentioned this in our yesterday's video, or earlier in this video as well, but it is what it is. I mean, $92 is going to be that support level to watch, and still long-term conviction still there. Like I said, I mean, this is a short. The company's earnings and revenue are still expected to grow in an environment like today, right? So imagine what they would do when we finally have interest rates coming down. Now, that's not the thesis, right? Again, I want to be very clear. A macroeconomic sort of event should never be your thesis. That's kind of like the cherry on top. Despite that, if Enphase is growing, right, if the numbers are getting better, yes, the margins are going to be coming under a lot of pressure. But if the company is still able to grow revenues and earnings, and that's all I'm looking for fundamentally, and the balance sheet's fantastic. So that's where we are. $92 is going to be that support, and right now starting to break down below this level of green rectangle for Enphase. So we'll go ahead and turn this level back into a resistance. So hope you guys enjoyed this video and a complete update on the markets. Definitely yields are playing a big role with where we are going. But nonetheless, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. That 16% annual discount that's available till the end of this month, and we'd love to have you on board. And as always, happy investing. I'll see you all in the next video.